Hello everyone and welcome to this IFRS IS 12 tax accounting course. It's part of a longer series. I started talking about current tax, and maybe recently I also started focusing on deferred tax. And this video is a continuation of the series on deferred tax. And in this video I will be focusing on how to determine the tax base of an asset. Like I said in the last video, what I try to do is to run through a snapshot of different tax calculations. On a summary basis, what does it look like? How do you do it? And that's what you see on your screen. So, like I said, you start from a book basis. You know what your book basis is. So your book basis is essentially the carrying amounts of your assets or liabilities in your financial statement or in your chart balance. So you look at it as what's the current value, what's the current amount. That's your book basis. So that's the balance, your accounting balance sheet. That's what you have in the book basis column. Pretty straightforward. You don't do any calculation whatsoever. You don't have to determine anything. You essentially just pick the numbers from the trial balance, and that's it. But for book basis, for tax basis, you need to be able to understand how IAS 12 expects you to determine the tax basis. How IAS 12 expects you to determine the tax base of each asset and liability. And once you then determine it, we then put each number in the tax basis column. So you really need to look at the standard to be able to determine what the tax basis of each asset and liability is. And that's what we're focusing on today. And as you can see, there are a bit other columns, and in separate videos I will be talking about how to make the determination of each of these other bits and pieces. But today I will be focusing on how to determine the tax base of an asset. I'll cover the key principles in some subsequent videos. I'll talk about a few other complexities, but the main principles that you need to go through to determine the tax base of an asset is what I'm going to try to go through today. And so we just go straight into IAS 12. And the definition you see on your screen is the definition of the tax base of an asset based on paragraph 7, I think, of IAS 12. And it says the tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the asset. If those economic benefits will not be taxable, the tax base of the asset is equal to its carrying amount. This definition is long, and if you're not familiar with it, it can be a bit confusing to understand. So what I've done in this case is to try and identify key steps that you need to go through to help you determine the tax base of an asset. And trust me, these steps that you can see are based on the definition in IAS 12, this definition. So if it's difficult to understand the definition in one go, no problem, just focus on these steps. And if you compare these steps to the tax base, you see that they're exactly connected. There's no artificial, I didn't devise anything new. It's just a way of trying to break down definition into smaller bits so that it's easier to understand. And so when you pick up an asset, the first thing you need to determine is to say, how does the entity expect to recover the carrying value of the asset? So if you pick up a PPE or say a machine, and the carrying amount is $100,000. So how do I expect to recover the value of the asset? Am I recovering it through use or recovering it through sale? In most cases, recovery through use is the default position, because you have a machine, you're going to use it to produce goods, and you produce goods and you depreciate it in the process. That's the way you recover it, and alongside you depreciate it until it becomes scrap. In some other cases, it's a building, which you then use the building to accommodate tenants and you earn rental income. So it still is by use. But in some other cases, you recover the carrying value through sale. So, for example, you bought a land for the purpose of capital appreciation, because the idea is that you expect the price to rise, and at some point in the future you will sell. So it means the recovery is through sale. So you need to sit down and determine whether it's through use or through sale, and it's the reality of the item or the circumstance that helps you to determine whether it's through use or through sale. But more often than not, the default position will be to say it's through use. If it's through sale, it will kind of be obvious. In some cases, some assets are recovered, have a dual basis of recovery, a portion through use, a portion through sale. I'm going to try to dedicate a separate video to talk about dual basis assets. But for now, the examples we're going to go through will just be one basis. It's either through use or through sale. And trust me, the illustrations helps to understand that point better. So that's the starting point, whether it's through use or through sale. Once you have made that determination, once you are done with step 1, step 2 is to then determine what is the economic benefit that will flow into an entity when they use that asset. So if I use a machine to manufacture, say, biscuits, what will be the benefits? It will be maybe manufacturer income. If I use building to hire tenants and to let out to tenants, the economic benefits will probably be rental income. Yeah. So that's the thought process to say what is the benefit that the entity is expected to derive for either using the assets or selling the assets. So you do step 1 and you then come to step 2. Then step 3, they're in 2 ways. And step 3 is you're going to choose either step 3A or step 3B, depending on whether the economic benefit is taxable or not. If the economic benefit is taxable, you stick with step 3A. If it is not taxable, you stick with step 3B. So if it is taxable, you need to calculate, okay, how much do I expect to be deducted from these economic benefits when I recover the current amount of the asset. So that's going to be a separate calculation. In some cases, it's obvious. In some other cases, it's not exactly obvious. But we'll go through certain illustrations. To help to explain how these steps works in practice. Then, if it's not taxable, that's pretty easy. Is to say the deductible amount is the current amount of the asset. Yeah, that's straightforward. And your tax base in step 4 is the amount you determine either by step 3A or by step 3B. So if it's if your economic benefit is taxable, then your tax base is the amount you determine under step 3A. If it is not taxable, your economic benefit is the amount you determine under step 3B. So these are pretty much steps. Happy for you to take screenshots and you can review them in your own time. Then let's do a couple of illustrations. So number 1 illustration is to talk about the tax base of a machine or a PPE. So I'm saying that in this illustration, the historical cost of the machine is $500,000. Accumulated depreciation as at the end of 31 December 2023 is $125,000. The machine is used to make products that generate manufacturing income. And the last point here is that capital allowances claimed as of the end of 31 December 2023 is $200,000. Let me just explain something before I move on. So the way tax works is, in many countries, is that when you have an asset, for accounting reasons, you depreciate an asset. But the tax authorities want you to disregard the accounting depreciation. And in many cases, the accounting depreciation is replaced with the tax depreciation, which is usually called capital allowances. So what it means is that for tax purposes, you cannot get a benefit of your accounting depreciation, but you then get a benefit of your tax depreciation, otherwise known as capital allowances. So if you look at this example today on the screen, depreciation claim till date, this depreciation expense till date is $125K, and that's why it's accumulated depreciation. But capital allowances enjoy till date, that you have claimed till date against your taxable profit, is a sum of $200,000. That's what you have enjoyed till date. And so let's go to the solution of this illustration. And I'm going to use the steps on this screen. We're going to use it to solve this illustration. So starting point, and I've solved it, but let's just go through step by step. So step one says, what's the mode of recovery of the carrying amount of this asset? If you go back here, it says on the third bullet point, it says the machine is used to make products that generates manufacturing income. So what it means is that the machine is used. You are using it to generate something. So it means the mode of recovery of the carrying amount of that asset is through use. And that's why you see the response I have here is use. Step 2 is to determine what the economic benefit is arising from the recovery of the carrying amount of the asset. And obviously, it's the manufacturing income, because it says the machine is used to make products that generate manufacturing income. And there's a point in between. So if the economic benefit creates a tax effect, then proceed to step 3A. So as I was saying that if the economic benefit is taxable, then you proceed to step 3A. And step 3A says calculate amount deductible from such taxable economic benefit. So looking at your balance today, how much more do you expect to deduct in future from the taxable profits that this asset generates? And we know that the cost of this asset is 500,000. We have enjoyed benefits, otherwise capital allowances, otherwise tax depreciation of 200k till this. So it means in future we expect to enjoy 300k capital allowances or tax depreciation. So that's the amount you are expected to enjoy in future. And when you go to step 4 says your tax base is equal to the amount you determine in step 3A or in step 3B. And in this case, we don't have 3B, so it's just 3A, and that's it. That's pretty much what it is. And so let's go but in practice, in reality, when you get more familiar with this, you don't necessarily have to go through this process. But as a beginner trying to be sure you're getting it right, you want to take your time to go through this process. But as you get used to it, as you get more experience, it jumps out at you. You look at it because you understand what the tax law says and you understand the principles of IAS 12, you are able to determine the tax base on the spot without necessarily going through this process. Illustration 2 talks about the tax base of an asset. So it says, determine the tax base of land at the end of 2022 and 2023, given the following information. So in 2022, Jacana Limited is a company based in Arendelle, acquired a piece of land for $5 million for capital acquisition purpose, recognizing it on a cost basis. So what it means is that you buy the asset and you are using the cost basis to recognize the value of the land. So the amount you bought is how much you are booking in your balance sheet. So credit bank and debit balance sheet land. Next point says, in 2023, Jacana switched to the revaluation basis and therefore revalued the land to $8 million. In Arendelle, which is a fictitious company, a fictional company, it says capital allowances are not available for land, so you can't get any deductions for land. Yeah, but it then says whenever the land is sold, the chargeable gain is determined as the net of the sales of proceed and historical costs. That's the illustration right there. And so we go through the steps to see how to determine the tax base. So step 1, mode of recovery. Yeah, I mean, if you go back to the illustration, the first bullet point, it says the land was bought for capital appreciation purpose. And so when you buy stuff for capital appreciation purpose, the thinking is that you expect the value to rise and you want to make a gain at that point. So the reason you have that land, is because you want to make a gain in future. And the way you want to recover the value of that asset is by selling it. And so the recovery is through sale. And so what's the economic benefit that will arise when you sell it? The economic benefit that you expect to arise is the sale proceeds. Okay, I've kept it for capital appreciation, so I'm going to sell it at some point in the future. And when I sell it, that proceeds will come to me. So that's what I expect to get. And so, and when you determine the recoverable amount, it doesn't have to be an amount you have figured out in your head. It doesn't have to be an amount that you already know. The only thing you need to know is that you know that you expect some amount to flow to you at some point in future, and that's what you need to put there. Not necessarily actual amount now. It's just for you to know that it exists. So in this case, it's the disposal proceeds or the sales proceeds. And it says the next question point is, if the economic benefit creates a tax effect, or if the economic benefit is taxable, proceed to step 3A. In this case, it's taxable. If you look at the last bullet point, it says when the land is sold, the chargeable gain, otherwise taxable gain, is determined as blah blah blah. So it means that gain, when it comes through, it will be taxable. So we then go to 3A, which is to calculate the amount deductible from such taxable economic benefit. Look at it this way: the economic benefit flowing to the entity's disposal proceeds. But if you go back to the scenario, what is being taxed is the chargeable gain, which is the difference between the sales proceeds or the disposal proceeds and the historical cost. So the economic gain that you're getting is the disposal proceeds. But what you're taxing is the chargeable gain, which is the difference between your disposal proceeds and historical costs. So it means you would need to deduct the value of the historical cost from the proceeds before paying tax on it. So when you look at the value, when you look at land as an asset in this scenario, the amount that is deductible against the future economic proceed is the historical cost. That's what you're going to deduct from the disposal proceeds you expect to derive in future. So that's the way you to go through in trying to determine what the tax base is. I know a couple of guys that say tax base is taxing the value of an asset. That's not necessarily correct. It'll be correct for people in many cases, but it won't be correct for many of the assets. So it's best to always stick to the definition provided by the standard. So let's go to illustration 3. It talks about the tax base of investments in subsidiary. So it talks about a company which is Mandela Limited and another company, Zambezi Limited. So Mandela is a parent of Zambezi, and Zambezi is wholly owned subsidiaries. The location, we're saying both companies are incorporated and resident in Limpopo Republic. The investment in subsidiary has a carrying amount of $6 million, which, what that means is that if you look at the balance sheet of Mandela Limited, you're going to see a value of $6 million for investment in subsidiary. And the investment in Zambezi Limited is worth $6 million. Recovery method, it says the kind amount of investment in Zambezi can only be recovered through sale of the shares. And tax treatment in Limpopo Republic, proceeds of the sale of the shares are not taxable if the investing company, in this case the investing company is Mandela Limited, holds at least 70% of the ordinary share capital of the investee company. The investee company in this case is Zambezi Limited. Yeah. So let's go on. So step 1, what's the mode of recovery? Pretty clear from the question. If you look through the fourth bullet point, it's obvious that the mode of recovery is through sale, because it says the investment can only be recovered through the sale of shares. Number 2 is, what's the economic benefit that will crystallize? Yeah, when you say you recover stuff through sale of shares, it means once you sell it, you get something, and that's proceeds, the proceeds from selling the shares. So that's the economic benefit that you get. And so the next point is, if the economic benefit creates a tax effect, if it is taxable, you go to 3A. If it's not taxable, you go to 3B. So we need to go and check the tax treatment, whether it is taxable or not. So it says if Mandela essentially owns at least 70% of Zambezi. If Mandela owns at least 70% of Zambezi, it means the proceeds are not taxable. In this case, if you check the first bullet point, Mandela owns 100%. That's what wholly owned means of Zambezi. So it means it goes above the 70% threshold, which means that the proceeds are not taxable. And because of that, we're going to go to step 3B, which is to determine the carrying amount. That's just the carrying amount, and that you have clearly in the question, $6 million. And the carrying amount will be the tax base in your step 4. So once the economic benefits are not taxable, then the carrying amount will exactly be equal to your tax base will be equal to the carrying amount. Pretty straightforward. But you need to understand. So I mean, if you look at it in reality, you may not have all these answers, which means you need to ask questions. What's the tax treatment? What's the economic benefits? If it's not apparent to you, but what these steps help you to do is to helps you to know the right questions to ask, and once you have the answers to the right questions, you can then use those answers to determine what the tax base is. Without knowing what the tax treatment is, it's impossible to determine what the tax base is. It's impossible. So you need to know what the tax treatment is, and that helps you to determine what the tax base is. And in the final illustration we'll do today, it's on interest receivable, and it's an unusual illustration. So it talks about Cassava Incorporation being a company based in Bongo Republic. Current amount of interest receivable in the statement of financial position of Cassava Inc. is 300k. We also know that in Bongo Republic, companies may elect to tax interest either on an accrual basis or on a cash basis. So the question is to determine the tax base of interest receivable on accrual basis or on a cash basis. Okay, so before I go to the illustration, to the solution, I assume everybody listening is an accountant, so it should be pretty straightforward. But for some reason, I'll just explain. So when you want to book interest receivable, the double entry is to do debit interest receivable and credit your income statement. So maybe your interest income. That's it. So if you're taxing it on an accrual basis, what it means is that once you book that entry, the interest income is in the accounts and the tax is payable in the year that you're booking to the accounts. But if it's on a cash basis, it means that even though the interest is in the P&L, you don't pay tax on it yet. You only pay tax on it when the interest receivable is paid to you. So now we can go into the solution. So what's the mode of recovery? Like I said, the default mode of recovery is through use. So in this illustration, we're doing it on an accrual basis. Let's keep that in mind. So when I say through use, we have the asset is interest receivable. How is it through use? You're using that balance to obtain interest cash, the interest from your borrower. So you have lent money to somebody, you have accrued interest income. The cash hasn't come in because that's the only benefit that can come. You have an asset already. The only benefit that can come to you is when the borrower pays in the cash to you. So that's the economic benefit that you expect to receive, and you're using that receivable to obtain that economic benefit. So the recovery is through use. It will be through sale on an unusual circumstance. It's maybe when you are factoring the interest receivable. I've never seen that happen before. It doesn't seem to be a common situation. So for most times, your receivables will be through use. You may not have to do anything about it. In most circumstances, it will be through use. So let's stick to through use. So economic benefit, like I said before, will be the cash that crystallizes when the borrower pays the interest over to the lender. And the question is, if the economic benefit is taxable, do step 3A. If it is not taxable, do step 3B. Because we're doing accrual basis, when you booked the interest, the income statement, like I said, that income has been taxed. So when the cash comes in, which is your economic benefit, that cash being your economic benefit is not taxable. You won't tax the cash. And because the economic benefit being cash in this case is not taxable, you will need to go to step 3B, in which case you will say you need to determine your carrying amount. And when you go to step 4, you then see your carrying amount is equal to your tax base. Simple. Because in this case, the economic benefit being the cash received is not a taxable amount. And you default to the position that says when your economic benefit is not taxable, your tax base is equal to the carrying amount. Pretty straightforward. So let's go to the second scenario, which talks about using cash basis. Mode of recovery is still the same thing. I have the interest receivable. I will recover the receivable by cash. When you pay over the cash, then I no longer have a receivable. It means I've used the receivable to obtain the cash. So the next step is to determine whether it's taxable or not. Because we say it's cash basis, it means we're going to tax the interest on a cash basis when we receive the cash. So it means when the cash is paid, we expect to tax it. So that amount will be taxable. Whatever that cash is will be taxable. Whatever amount it is will be taxable. So we won't go to step 3B. We will rather go to step 3A. And in step 3A says, calculate the amount deductible from such economic benefit. Say, okay, when we receive the cash and it's due to be taxed, would there be any amount we deduct away from the interest? No amount, because that interest needs to be taxed. So, for example, if the interest income if we go back to the scenario, you expect the receivable is 300k, and that's how much cash you expect to receive. And when that cash comes in, there will be no amount to deduct from it based on the scenario. No amount, no deductions from it. So the amount deductible from that cash, from that economic benefit, is zero. And it means your tax base is zero. And pretty much that's it. It may take a while to understand this fully because it's quite an unusual concept. But if you watch the video a few times, if you take any other assets on your balance sheet that you're familiar with and you understand what the tax rules are, just patiently go through the definition and the steps to try to determine the tax base. And in no time, you get used to it. So take your time to watch this video a couple of times, read the definition properly, try your hands on a couple of assets that you're familiar with the tax implications in your jurisdiction. And it should come to you. You should get familiar with it with time. And with experience, you get better at it. So I guess I'll just stop here now. And I just begin to prepare for the next video at some point. Take care of yourself. Bye-bye.